You are 19 years old. You have $847 in your checking account and an idea you can't stop thinking about. It's 2 a.m. You're in a dorm room that smells like instant ramen and ambition. Your roommate is asleep. You're building a landing page on a laptop held together with electrical tape. You don't know how to code properly. You're using a template you found for free. You change the colors. You write copy that sounds confident, even though you have no idea what you're doing. You hit publish. 3 people visit in the first week. One of them is your mom. You don't quit. That's the only advantage you have at this level. You can't quit because you haven't started enough to fail yet. You read every blog post about growth hacking, customer acquisition, product market fit, terms you don't fully understand, but you write them down anyway. You cold email 200 people. 12 respond. 1 becomes your first customer. They pay you $47. You stare at the PayPal notification for 11 minutes. That's the moment. Not because of the money, because someone you don't know gave you money for something you built. The geometry of this shifts everything. You're not an employee anymore. You're not trading hours for dollars. You built something once, and someone paid for it. That's leverage in its earliest form.
You drop out or you don't. Doesn't matter which. What matters is you go full-time on this. You move into a cheaper place. You eat the same meal for 9 days straight because it's $1.80 and you need to extend your runway. Runway. You learned that word last month. Now it's the only number that matters. You have 4 months of savings left. You build in public. You post your revenue numbers on Twitter. Month 1, $47. Month 2, $340. Month 3, $190. It goes down and you post it anyway. Month 4, $1,100. You don't know why it jumped. You study everything you did that month. You try to reverse engineer your own accidental success. You find a pattern, you repeat it. Month 5, $2,400. You hire someone. Not full-time, just contract work. $300 for a logo redesign. It feels like the most money you've ever spent. You're 20 years old now. You have $11,000 in monthly recurring revenue. You still live in the cheap place, you still eat the same rotation of 4 meals, but something has changed in how you see the world. You notice businesses everywhere. You see a coffee shop and you don't see coffee. You see foot traffic, unit economics, customer lifetime value. You can't turn it off. The first rule at this level: you are the product, the marketing, the support, the engineer, and the janitor. There is no team to delegate to. There is only you and the work. You wake up at 5 a.m., not because you're disciplined, but because your brain won't stop. You work until 11 p.m., not because you have to, but because there's always one more thing, one more email, one more feature, one more optimization. Your friends from school have jobs now, real jobs with health insurance and 401k matches. They ask what you do. You say you run a company. They ask how big. You say it's early stage. You don't tell them you made $8,000 last month and spent $7,400 on ads and software and contract work. You don't tell them you haven't paid yourself a real salary in 7 months. You raise your first money, not from a VC, from an angel investor you met on Twitter. $25,000 for 5% of your company. You don't know if that's a good deal. You take it anyway because you need 14 more months of runway. The money hits your account. You feel rich for 48 hours. Then you realize it's not your money. It's the company's money. And now someone else has expectations. You're building a team now. 3 people, a developer, a marketer, a customer success person. You're managing people for the first time in your life. You have no idea what you're doing. You have one-on-ones because you read that's what you're supposed to do. You ask them how they're doing. They say, fine. You talk about roadmaps and KPIs. Everyone nods. No one knows if this is working. Your revenue is $34,000 a month. You pay yourself $3,200. You pay your team more than you pay yourself. That's the shift at this stage. You're no longer optimizing for your own income. You're optimizing for growth. The company needs to eat before you do. You lose your first customer. Not because the product is bad, because you didn't pay attention. You missed their email. They churned quietly. You don't find out until you see the Stripe notification. You learn a second rule. Retention is cheaper than acquisition. You build a system to never miss an email again. You close your first enterprise deal, $24,000 annual contract. You negotiate for 3 weeks. You give them a discount you shouldn't have given, but you need the logo. You need the case study. You need proof that you belong in this category. The deal closes. You put their logo on your homepage. 2 more inbound leads come in that week. That's social proof. That's the currency at this level. You're 23 years old. You have 14 employees. Your revenue is $140,000 a month. You just raised a seed round, $1.2 million at an $8 million valuation. You own 68% of the company. On paper, you're worth $5.4 million. In reality, you have $11,000 in your personal bank account. You move into a real office, nothing fancy, but it has a door and a conference room and a wall where you hang the company values you wrote at 3 a.m. last Tuesday. Growth, transparency, customer obsession. You believe them when you write them. You hire a VP of sales. He's 19 years older than you. He's worked at 3 companies you've heard of. In the interview, you pretend you know what you're talking about. He joins anyway. Either he believes in the vision or he couldn't find anything better. You don't ask which. He builds a sales process. Suddenly you have a pipeline, a CRM, a forecast model. Revenue becomes predictable. You start thinking in quarters. You have a board now, 3 people, your lead investor, your angel, and you. You prepare a board deck, 60 slides, metrics, cohorts, burn rate, growth rate, competitive landscape. You present for 90 minutes. They ask questions you don't have answers to. You write them down. You find the answers later. The third rule at this stage: you don't need to know everything. You need to know how to find everything. Your job is changing. You're not building features anymore. You're building a machine that builds features. You're not closing deals. You're building a team that closes deals. The abstraction is disorienting at first. You miss the early days when you could see the direct line between your work and the outcome. Now the line is blurred across 14 people and 4 departments. You have your first real failure, a product launch that took 4 months and $60,000. You announce it. The market doesn't care. 8 customers sign up in the first month. You expected 200. You shut it down. You write a postmortem. You send it to the team. You take responsibility in the email. In private, you wonder if you're out of your depth. You don't quit. You ship the next thing. It works. You're 26 years old, 70 employees, $4 million in annual recurring revenue. You just closed a Series A, $8 million at a $35 million post-money valuation. You own 52% now. Dilution is the price of growth. You understand that intellectually. Emotionally, it stings every time. You hire executives, a CFO, a CTO, a CMO, people who have done this before, people who know what inning this is. You sit in meetings where they use terms you have to Google later. EBITDA margins, CAC payback period, net dollar retention. You learn fast. You have to. You're the CEO, but you're no longer the most experienced person in the room. That's the shift at this level. Your job is not to be the smartest. Your job is to make sure the smartest people are aligned. You start traveling. San Francisco, New York, London, Toronto. You take meetings with VCs, with partners, with potential acquirers. You're always selling. Selling the vision, selling the growth, selling the inevitability of your success. You learn to tell the story in 3 minutes, in 10 minutes, in 45 minutes. Same story, different depth. You get good at it. You have to. The story is the product now. You lose a co-founder, not because of performance, because of vision. They want to sell, you want to build. The conversation happens over coffee. It's civil, it's clear, it's final. You buy them out. The lawyers handle the details. You don't speak for 8 months. You're not friends anymore. You're not enemies. You're just people who wanted different things. The company keeps moving. You stop counting hours. You stop counting days. You think in quarters now, in years. You measure success in ARR growth, in net retention, in enterprise logos. The metrics become the reality. You're managing a P&L now. $18 million in revenue, $14 million in expenses. You're not profitable. That's intentional. You're investing in growth. The board agrees. The market agrees. Profitability is for later. You have a competitor now. Well-funded, well-connected, growing fast. You watch their every move. You track their hiring on LinkedIn. You read their blog posts. You compare their messaging to yours. It keeps you sharp. It keeps you paranoid. Paranoia is useful at this level.
You're 29 years old, 200 employees, 22 million in ARR. You just closed a Series B, $35 million at a $180 million valuation. You own 38% of the company. You're worth, on paper, $68 million. You still pay yourself $160,000 a year. You could pay yourself more. You don't. It's not about the salary anymore. You have liquidity conversations, secondary sales, early exits for employees, founder shares on the table. You sell 5% of your stake, $9 million pre-tax. It's the first time you've taken money off the table. The wire hits your account. You feel nothing. Then you feel everything. Relief, guilt, fear, validation. You don't tell anyone except your accountant and your spouse. You buy a house, not a mansion, just a house. 3 bedrooms, a yard, a mortgage you could pay in cash, but you finance anyway because the interest rate is low and capital is cheap. You donate $400,000 to scholarship funds, anonymously. You don't post about it. The recognition isn't the point. You're building a category now, not just a product, a category. You speak at conferences. You write thought leadership. You go on podcasts. Every appearance is marketing. Every word is positioning. You're shaping how the market thinks about the problem you solve. You hire a PR firm. They get you in Forbes, TechCrunch, Bloomberg. The articles say you're a visionary. You read them and feel like a fraud. You're just someone who didn't quit. But you don't correct the narrative. The narrative is useful. You have an acquisition offer, $240 million cash and stock. You take the meeting. You hear the pitch. You say you'll think about it. The board wants you to consider it. You consider it for 9 days. You say no, not because the price is wrong, because you're not done building. The 4th rule at this level, the exit is always there. The question is whether you're ready to stop. You're not ready. You lose your best engineer, poached by a competitor. They offer him $400,000 in VP title. You counter. He leaves anyway. It's not about the money. It's about the stage. He wants to be at a rocket ship. You're not a rocket ship anymore. You're a company. That's the tax of success. The best people want the early chaos. You're past that now. You're 33 years old, 450 employees, $67 million in ARR. You're profitable now, $4 million in net income last year. The board is talking about an IPO. You hire bankers, Goldman, Morgan Stanley. They build a model. They say you could go out at a $900 million valuation, maybe $1.1 billion if the market is strong. You start the process. S1 preparation, roadshow decks, analyst meetings. You meet with institutional investors, Fidelity, T. Rowe Price, BlackRock. You tell the story for the 100th time. They ask about margins, about competitive moats, about TAM expansion. You have answers for everything. The IPO launches. First day pop, 23%. You close at $1.3 billion market cap. You own 32% after dilution. You are worth $416 million. You ring the bell. Your team is there. Your family is there. Cameras everywhere. You smile. You say the right things. You feel proud and empty at the same time. You don't know why. You're public now. Everything changes. Quarterly earnings calls, analyst expectations, stock price obsession. You check the stock every morning. You tell yourself not to. You check anyway. The market is irrational. Your revenue grows 38% and the stock drops 12% because the market expected 42%. You learn the fifth rule. The market doesn't care about your effort. It cares about the delta between expectation and reality. You manage to that delta now. You're 40 years old. The company is worth $4.7 billion. You've stepped back from CEO. You're executive chairman now. You hired a CEO with enterprise experience, someone who can scale to 500 million and beyond. You still own 28%. You are worth $1.3 billion. The number is abstract. You don't feel different. You have 3 board seats at other companies. You angel invest in 40 startups. You run a small venture fund, $50 million, focused on early-stage B2B software. You're on the other side now. You see 19-year-olds with ideas they can't stop thinking about. You take their meetings. You listen. Some of them remind you of yourself. You write checks, not big ones. $25,000, $50,000, enough to give them runway. You don't need the returns. You need to stay connected to the beginning. You speak at universities. You tell them the story. You leave out the fear, the uncertainty, the nights you thought it was over. You give them the highlight reel. That's what they want to hear. You donate $11 million to entrepreneurship programs. You fund scholarships, incubators, accelerators. You want to build the infrastructure you didn't have. You're 57 years old. You sold your stake in the company. $970 million after tax. You run a family office now. 15 people managing investments across venture, real estate, public equities, and private credit. You don't need to work. You work anyway. You're building again. A new company. Smaller, quieter. You're not trying to build a unicorn. You're trying to build something meaningful. The difference matters now. You have access everywhere. Every VC takes your call. Every founder wants your advice. Every LP wants you on their cap table. You are the signal. You invest in 11 companies that year. 4 of them will fail. 3 will return capital. 2 will 10x. 1 will 50x. That's the distribution. You know it. You accept it. You're 68 years old. You've started 6 companies, sold 4. 1 failed. 1 is still running without you. You have more money than you'll ever spend. You give most of it away. Foundations, scholarships, climate tech, education access. You don't announce it. The work is the point, not the credit. You write a book, not a memoir, a manual. How to build, how to fail, how to recover. It sells 40,000 copies. You don't care about the sales. You care that someone on page 1 finds the thing you wish someone had told you on day 1. You take one last meeting. A 19-year-old with $800 in their account and an idea they can't stop thinking about. They're nervous. You're not. You listen to the pitch. It's rough. The numbers don't make sense. The market is crowded. The differentiation is weak. You write a check anyway. $25,000 for 3%. Not because you believe in the idea, because you believe in the person who won't quit. Somewhere in a dorm room that smells like ramen and ambition, a terminal blinks. A landing page goes live. 3 people visit in the first week. One of them is their mom. They don't quit. The machine takes another step forward.